Hi, I'm James and welcome back to Accounting Stuff. In this video, I'll attempt to explain simple and compound journal entries in less than 2 minutes. Start the clock. What is a simple journal entry? Well, a journal entry is a record of a financial transaction in an accounting system. Simple journal entries are used for straightforward transactions that involve just 2 accounts. We have one debit in the left column and one credit in the right column. Let me explain with an example. Chicken Duck's Dreamland is a petting zoo. On September 1st, the business buys a new feed delivery system for $10,000 in cash. How do we record this transaction in a journal entry? We start with a unique journal number to help us identify the transaction. Then we add a posting date which tells us when the transaction took place, followed by a short description which explains the purpose of the journal. Now we need to enter the account names. This is a simple journal entry, so it only involves 2 accounts. On the one hand, we want to increase feeding equipment to record a new fixed asset on the balance sheet. And on the other hand, we want to decrease cash, which is a current asset, also on the balance sheet. Both of these are assets, which means they're normal debit accounts. So debits increase them and credits decrease them. We debit feeding equipment by $10,000 to increase it and credit cash by $10,000 to decrease it. The total debits match the total credits because in double entry accounting, every journal entry has to balance. Now, what is a compound journal entry? Compound journal entries are used to record transactions that involve 3 or more accounts. There could be multiple debits, multiple credits, or a combination of both. We can tweak our example to demonstrate this. Chicken Duck's Dreamland buys a new feed delivery system. It still costs $10,000, but this time they pay $6,000 in cash and put the remaining $4,000 on credit. Now the transaction involves 3 accounts: feeding equipment, cash, and accounts payable. So we can record it in a compound journal entry. First, we debit feeding equipment by $10,000 to increase fixed assets. Then we credit cash by $6,000 to decrease current assets. And finally, we credit $4,000 to accounts payable because Chicken Duck have an obligation to pay the supplier in the future. As you can see, this is a compound journal entry because it involves 3 or more accounts. But it still follows the rules of double entry accounting because the total debits match the total credits. If you'd like to grab a copy of my journal entries cheat sheet, then you can find that right here. And if you'd like to learn more about accounting, then why not give this video a watch next? And I'll see you there.